Hi, and welcome back to our weekly market update with Morton Brown Family Wealth. I'm Dennis Morton here with Katie Brown and Cody Demmel. How are you guys doing?
Great. How are you today?
Great. It's the week of June 22nd, and we're leaning into our 4th of July week starting in a couple of weeks. It's the end of the second quarter, and we're starting to think about what the next phase of this COVID-19 experience is going to look like. So 3 things we're going to talk about today. One is, how is the market looking at the next few months of a second wave of COVID? How might it respond? The second thing we're going to talk about is regulation best interest, or RegBI, and what it changes for financial advisors and the kind of information they have to disclose. And the third thing we're going to talk about is home economics, how differences in policy decisions could change how each household thinks about money and where they place value on career and spending and everything else. So a lot of complicated financial decisions that impact all of us. So let's start with an article that came out this week, actually from Charles Schwab by Jeff Kleintop. It's called "What a COVID-19 Second Wave Means for Investors." So that's what is top of mind for a lot of us right now. We've seen an uptick in COVID-19 cases as certain states have opened back up, especially in the Sun Belt. But there's also differing statistics that the market is keeping track of. Cody, could you pull up the chart that Jeff Kleintop put together on the trend on cases versus deaths?
Yep.
So what we see here is the 7-day moving average for global COVID-19 daily cases and COVID-19 daily deaths. And you can see over in the April timeframe how we peaked out on the death cases after spiking up dramatically in both deaths and cases. This second wave that you see forming here of cases is coinciding with a general decline in deaths. There's a little bit of a spike up here. And what Jeff Kleintop brings up is that the second wave isn't so much a resurgence in places where the virus has already gone through, like Italy or Western Europe. It's more of an extension of the first wave that's happening in places like India, where they're still seeing the initial trend developing. So the second wave globally look like that. And the US numbers look very similar. In fact, there's a more dramatic decline in the death rate, even with a spike up in cases. All of this is important because the market isn't responding to case numbers necessarily. It seems to be responding toward the mortality rate, really. So Cody, the second chart we have shows a little bit of the market response.
Yep. Here we go.
So what we have here is a chart of the global stock index upside down. So the green line shows when the green line is going up, it means the market was actually going down. But the reason we do that is because we're plotting it against mortality, against the daily death rate over the last so many months. And what you can see is the global stock market, as the death rate increased, the global stock market dropped until it bottomed out right here. And this is with a 28-day lag. So the death rate is lagged back by about 28 days. And then the trend here as the market rebounds, as the death rate declines. So you see this uptick here at the end, and that's the big question mark. If we do start to see an uptick in the death rate, what happens to the stock market? Is that what we're really seeing questioning here as we got these big drop-offs here in the last couple of weeks? So cases are going to get a lot of the headlines, but the market is really looking at what is the actual mortality rate that's associated with it. What did you guys take out of the article, or any observations just kind of the second wave and how to think about it as investors?
No, I thought it was really interesting that they brought this forward, the connection between the market and the death rate, not as much as the cases. We're definitely seeing a significant increase in cases, but I think a lot of that is from the increase in testing. As companies are opening up, and a lot of companies making it part of their standard process to make sure to do consistent testing for their employees, it makes sense that we would have an uptick in the number of cases, but a number of those people testing positive, it is not impacting them to as great of a degree. And so we're not seeing that increase in the death rates yet. And I think that's important to kind of keep that in the back of your mind, that we can see those increases in cases, but it's not necessarily going to directly align with an increase in deaths, even though we have had a little bit of an uptick.
And what about the shutting down, Cody? How do you think about the shutdown and what the next phase might look like if there are, increased cases or increased deaths?
I mean, that's obviously a moving target. I mean, hopefully we don't have to have another shutdown or some drastic changes will have to happen. But Mike Wilson, who was the chief economist at Morgan Stanley, he did an interview last night, and he was saying that if we do have to have another shutdown, that we are going to need another couple $1 trillion in stimulus to make sure that we don't have to have another huge market decline that we've had in February and March.
And I think that's what the policymakers are wondering about is what do they need in the arsenal to try and address this should it come back, and then that continues to be the target. Let's move on to a question that impacts our industry, our clients, and really investors as they try and get financial advice. Katie, as of the end of this month, Regulation BI comes into play. What is it, and why should we care about this?
Yeah, so it's Regulation Best Interest. This has been in the works for a while. It was actually passed last summer, but then, as you mentioned, Dennis, all financial advisors need to be compliant by the end of this month. This is kind of the replacement of the fiduciary rule that got squashed a few years ago, and it's an effort to provide more information to the consumers so that the consumers can better understand who they are working with, and if somebody's holding themselves out as a financial advisor, that they are in fact giving advice. That term has been a little bit loose. The efforts of the regulators to kind of even the playing field between a broker and a financial advisor. There's an article in Forbes the end of May, we can link it to this, and it was, what does Regulation Best Interest mean for your financial advisor? And they did a really good job explaining, a registered investment advisor, as we are registered directly with the SEC. We're held to a fiduciary standard to always put our clients' best interest first. That's different from somebody that is a broker. And as a broker, they're essentially the intermediary person. So they're not there to necessarily give the advice. They're there to execute trades. And so they have been held to a suitability standard, meaning that they could sell commission products, and as long as it was suitable, they could sell it to the consumer, even if it meant a higher commission for them, because they were a transactional intermediary. And so this is trying to even the playing field a little bit and to let consumers know who's sitting across the table from them. And are they approaching them as a broker, or are they approaching them as a financial advisor?
Yeah, and I think what it ends up being is a huge stack of papers.
Yes.
A lot of disclosures. We reviewed one that was 20 pages long today, which was an explanation of this new disclosure. But you start to find these interesting conflicts of interest in there too. So things like how advisors are sometimes given incentives to keep the money managed in-house. So if ABC Brokerage employs the advisor, and ABC Brokerage also has a particular fund that they run, the advisor might get more compensation for keeping that with that fund instead of going out and using Vanguard or using iShares or using some other. So that conflict exists, and you're allowed to do it as long as you disclose it somewhere in that volume of documents.
And that's some of the challenge with this new regulation, is that it is a little bit of a half measure. Rather than holding them truly to a fiduciary standard, this best interest really requires them to disclose. And in a sense, almost saying it's okay to still do some of that as long as you're disclosing it. So it does still keep a lot of the homework on the client side to determine, is that okay? Am I okay with that? And to kind of read through and shuffle through those large disclosure documents. But it is important to bring up at this time, because I know we just sent out our CRS, which is the client relationship summary document to disclose all of our conflicts of interest. Interestingly enough, for our world, it's basically a summary of our previous disclosures that we had already sent out. So it's not any new information, but to get that from other brokers, that's a whole new world for them to send out those disclosures. I think the other, to your point too, Dennis, that why there's a little bit of frustration and feeling like this is a bit of a half measure is that the original fiduciary rule had proposed bans on, sales competitions and meeting quotas, and the regulation best interest did not remove any of that. So once again, they can still have a lot of those sales contests in there and those commission-based contests as long as they have it somewhere printed in their disclosures that they're doing that.
Cody, we all got our start on the broker side before migrating over to the investment advisor side. You've done that more recently than us. What's your take on what this does for providing advice for people? How should they view their advisor differently?
Yeah, it'll definitely be interesting to read some of those disclosures that some of the larger broker dealers have to put out. Because like Dennis said, coming from the larger broker dealer to an RIA, the reason I wanted to do this is because I always wanted to have a fiduciary standard. And being a RIA, we are held to that fiduciary standard, along with me getting my CFP later this year. I just think it's going to be, good for the client that there's going to be more disclosures, but like Katie said, it is kind of a half measure of them like just disclosing that they're doing it. It doesn't mean that they're going to stop doing it.
Right. So one last thing we want to touch on today, we're calling this home economics, and something that we're thinking about from a financial planning perspective. So think back to a few months ago when people were mostly quarantined inside their homes. Homeschooling was happening. Parents were staying away from their jobs. That's going to change a little bit as we enter the new school year. So children suddenly might be only going back to school for a couple of days a week. There might be combinations of remote learning and on-site learning. But their parents may have been, gone green and head back to the office or back into their jobs. And that support network doesn't exist at home. So children might be home alone. And if you're a grandparent and somebody who might be looking at the situation, it changes the economics of your family dynamic. If somebody's got to make decisions about care and who stays home and some other things Katie, what do you think about some of the decisions that families are facing right now?
Yeah, and you're exactly right. It is a financial planning consideration. It's a consideration on a lot of levels. But I know, and it's something actually that we are discerning in my own personal family too, looking around and saying, okay, how are the schools right now with as much information as we have, because we don't know for certain, how does it look as if they're going to open up in the fall? What is that schedule going to be like? How is that different from maybe some other schools in the area? So, we're considering things along the lines of, do we look at a different school? Do we perhaps bring a nanny to the house to assist because we don't have family nearby? And I think somewhere there's going to have to be a gap filled. So whether it's the parents making a decision that somebody's going to stay home or modify their job if they have the ability to stay home, or if it's daycare stepping up to help fill a gap, or if it's, grandparents coming in, or if the parents are spending, extra money to send their children to a school that may be opening up a little more traditionally. So there are a lot of planning considerations, whether you have less income coming in the door or more expenses going out, and just a lot of coordination and juggling that may have to happen within the family.
I think we could even see, imagine if you're within, stone's throw of retirement age and seeing the ability to help out your children and grandchildren, that may change your decision about whether to keep working or whether to pivot and start helping out there. And also, Cody, you don't have any kids yet, but what happens to property taxes? These school districts are in some pretty deep holes right now, and there's a lot of challenges. They're going to have to spend a lot of money to be compliant with other things. So even as a resident of a school district, your economics could change because taxes go up.
Yeah.
So I think we're still living in this world of second order effects and trying to think of what the market's going to do and also the kinds of decisions that we're going to have to make. So if you're thinking through any of these things and wondering how we might frame them, or is gathering insights from how other people are dealing with them, feel free to reach out. Always happy to have a conversation. Look forward to catching up with everyone next week, and we'll talk to you again soon. Take care. Have a good night.
Take care.